5 stocks to buy April 2023. Welcome back to the Stock Dash channel. I'm your host, Chris. This is where we talk all about amazing stock picks with growth and valuation analysis. And in this video, we're going to be discussing everything you need to know about these stocks for the short term and the long term. If you're excited, smash the like button and let's get started. If you're new to the channel, welcome and consider subscribing because we have videos like this every single week. So the first stock on this list, number 1, is going to be JFIN stock, Jiayin Group. JFIN stock is a $200 million market cap, trading at about $4 per share here as of this recording. What the company does is that it takes lenders and connects them with potential clients using its algorithms, big data analytics, and risk management system, and make sure that those loans are as risk-free as possible. Now, obviously, some people are very concerned about these types of companies going into a bad economic cycle. A lot of people think that we're going into a recession. In China, it's probably a bit better because they actually have already been in a recession and they've been reopening their economy. And as people continue to reopen their businesses and more people spend money, they're actually going to be borrowing more money. So the loan industry, I expect in China, will actually continue to grow into 2023 and beyond. We're already seeing a lot of that, but let's take a look at some of the numbers here, specifically with JFIN, because if you compare it to a lot of other companies, like American companies, for example, like Upstart, those have been trashed, but JFIN is actually doing very, very well. So if you look at the past quarter when they reported earnings, their net originations for loans, like new people getting loans, right? The value of those loans have actually gone up massively, over 200%. So you can see that they're actually gaining more market share in a somewhat difficult environment, right? Regulatory environment as well as economic environment in China. Looking at the full year results, not just Q4, you can see that the total revenues increased by over 80% and net income increased by over 150%. So this business is absolutely on fire. It's a relatively small business and a small market cap for this company, but we can see the very obvious growth here and the long-term potential for this as well. Now, because they're doing so well and this company is very flush with cash, they're going to pay, starting this year, a biannual dividend to return no less than 15% of net income of the previous year. So this past year, they just had net income of over $115 million, which is absolutely insane when you consider, again, the total market cap of this company is $200 million. So in 2 years, they could make enough money to buy the entire company. They also have a share repurchase program of $10 million outstanding. They did spend a couple million to already buy some shares. I think they'll continue to buy those shares. And on their earnings call, they stated very clearly they believe the stock is undervalued. They want to return money back to shareholders. I alluded to this earlier, but let's not ignore the fact that this company is trading at a PE ratio of less than 2, right? A lot of other companies in the fintech world are trading at price to sales of, more than 2. So price to earnings of 2 is phenomenal. JFIN's loan delinquency profile is also very good. Management really stresses the fact that they are being conservative with their business practices and their guidance for the coming year. And yet they're still guiding for about 20-30% growth in loan originations. And their delinquency rates are very low. If you look at the most recent series of loans that they have, it's less than 2% delinquency. Over time, they've continued to lower that. So they're not just issuing more loans or connecting more loans with people that are defaulting. They're actually connecting, qualified lendees to these lenders, and they don't expect these loans to default anytime soon for the most part. So it's totally a different business than what you've seen with a lot of other companies. And even if you compare it to some of the great other Chinese lending companies out there, like QFIN, like FinV, which I've covered in my analysis in the past, you can see that this one on a PE ratio basis is trading at half or even a third of the value of those 2 other larger players. By the way, if you're watching this video and you haven't even started to trade stocks yet, one of the apps that I recommend is Moomoo. This has a lot of great analysis within the app, letting you look at the financials of the company, letting you do some chart analysis as well if you want to draw support and resistance. And they do have a lot of great promotions all the time for new users. I have a link in the description. Go check it out. You could get around 15 free stocks. Number 2 on this list is Bank of America. This is Warren Buffett's second largest position in his entire portfolio. If you look, he's been building this position over time for the past decade, right? Even going back to the previous financial crisis in 08-09. In the resulting couple of years after that, banks really needed a lot of help, and Warren Buffett was one that stepped in there and bought a lot. He invested a lot into the company and has reaped big dividends, literal dividends, right? This company pays about a 3% dividend here today and trading at rock bottom prices. I mean, over the past couple of weeks, bank stocks have been slaughtered, and Bank of America is trading at lows that we haven't seen for a couple of years, trading about $26, $27 per share. I think in the long term, if you look at it, most of these banks, maybe not all of them, but most of these banks, especially the big banks that are too big to fail, like JP Morgan, Bank of America, give it 6 months, a year, I can almost guarantee you that these will be trading higher. In the first few days following the collapse of Silicon Valley Bank and Signature Bank, the Fed had given a lot of liquidity options to these banks to borrow money in case they needed it. And a lot of these banks borrowed a lot of money, right? Billions and billions of dollars. But over the past couple of days and couple of week or two, you can actually see that the lending has actually subsided. Some of those larger banks like Bank of America, JP Morgan, have already reported that they've seen a net inflow of assets over the past couple of weeks. So the business has not gotten worse, and yet the stock has gone down. Bank of America's trailing price to tangible book value per share currently is about 1.26. The mean is 1.64. The price to earnings ratio right now is 8.6. The mean is 12.6. So, inferring from that, you can see that Bank of America has approximately a 30 to 50% upside from here. And so objectively, I think that this shows you that Bank of America is probably an undervalued stock here. Number 3, Parry stock. This is one of my favorite stocks of all time and one of my best calls actually over the past couple of years. Parry is an ad technology company, and over the past year, it's gone from about $25 per share to a high of $42 recently for a stunning gain here. Now, Parry is a growth company because over the past couple of years, it has consistently recorded a compound annual growth for its revenue of over 30%, and its net income has grown over 100% as well from year to year. They are a Microsoft supplier for Microsoft Bing, which is doing very well because they're integrating ChatGPT, and for every market share gain for Microsoft Bing, that's a lot more revenue for Parry. They have an exclusive multi-year agreement, so very awesome stuff there. And they also doing a lot of stuff with connected TV, with ads that can be connected to e-commerce. So when you see an ad on TV, you can actually shop directly through that ad through a QR code. And their true differentiator is that they have a cookieless ad targeting solution called Sort that is getting more and more clients. And with the balance sheet, Parry has a $430 million cash pile and no debt on its balance sheet whatsoever. So they can take that cash and invest it into potentially acquiring another business to increase their income and their revenue inorganically, while the organic side is also still doing very well. Now, Parry still trades very favorably when compared to competitors like Magnite, PubMatic, TTD, which have much higher valuations. Parry only trades at an 18 PE ratio. With that cash factor into it, the valuation is even cheaper, but I will say it is honestly not as cheap as it used to be when it was $25 per share, right? Back then it was like a 12 PE ratio, and I thought people were crazy for not buying this stock. At this point, it is still a good valuation. It's just not a crazy good valuation. If this stock were to dip back into the mid 30s, for example, I would say it's a screaming buy. But right here, it's still a good buy. Stock number 4, Schwab. I really want to talk about this one because I think Schwab is that extremely undervalued stock here right now in the market, and I think everyone is not thinking about it correctly. So Schwab has been taken down with a lot of other bank stocks, especially the regional banks. Schwab is down over 35% year to date. Schwab is primarily a brokerage, a financial services company. They have 7.3 trillion in client assets. They have millions in regular stock trading accounts. They also have a retirement account services. They have stock awards if you're in a company that issues shares, restricted stock units. And they have just part of their business is the bank, right, where they have deposits. So it's not like there's going to be a big bank run on Charles Schwab, because that's not really the main part of their business even. And they have over $100 billion in liquidity, which is more than the entire company's market cap at this point. If you look at the real data in terms of net asset inflows, they've actually been getting more money into their deposits, not money going out of it. There are some people saying that Charles Schwab has all of those bonds on his balance sheet and those bonds are not very profitable, and they are actually at an unrealized loss. They have 20 billion expiring this year, 16 billion expiring the next year, and so on for a couple of years. And that's something that hurts profitability, because they could be having that money in higher interest rate bonds instead. Like, they do have a small portion that is earning about 3.7%, and the others are not really earning much at all. But that's not new information, right? This is reported as of last year. Now, there's also people saying that clients are gonna pull money from their brokerage and put it into a money market fund that gets a much better interest rate than the sweep program that Charles Schwab offers, that gives the client a much smaller interest rate. However, this is a trend that is also not exactly new. And if you look at the data over the past couple of months compared to last year, the rate at which people are putting their money into money market funds has actually been slowing down. And as the stock market improves, I think people would rather put their money in stocks or have it in their brokerage account ready to use, as opposed to a money market fund. We'll find out more about Charles Schwab's reality when they report their spring business update and Q1 results on April 17. But all that aside, just looking at it from a valuation perspective, this is trading currently at around a 14 PE ratio, when historically, once again, you look at the mean PE ratio is more like 22. So over a 50% upside here, just if it trades at an average PE ratio. And finally, stock number 5 is Western Alliance Bank. Once again, another bank, but I do think that this is the area where there is the most opportunity right now in the stock market. By the way, I do think that a lot of those tech stocks that have been going up, that's because people needed to sell their banks and put their money into some other industry, some other sector, right? But I think there will be a sector rotation and people will get back into these banks. And when they do, those stock prices are going to go up. But with Western Alliance especially, Western Alliance is currently down over 50% from its recent high of around $70 before the whole crisis happened with SVB. Over the past quarter, they just came out with the update that they have lost about 11% of deposits, which was actually much better than expected. Some analysts were expecting a 15% loss. But if you look at their update, you'll see that at the end of the quarter, since March 20th to the end of the quarter, they actually gained about $900 million in deposits. So most of that loss happened in the first couple of days with the Silicon Valley collapse. Since the end of March, right, the beginning of April to April 4th, that's just 3 or 4 days, right? They have seen a net inflow of $1.2 billion in deposits again. So they've started to recoup those deposits already. Their profitability has only been increasing as rates have been going higher. If you look at Wall's Q4 results over the past year, they had rising net income, rising revenue, rising net interest margin, total assets of $67.6 billion, $52.7 billion in net loans, $53.6 billion in total deposits, and total equity of $5.3 billion. However, Western Alliance right now is trading as if it's headed towards bankruptcy because its equity is being valued at less than 1-to-1. For every $1 of equity, it's actually being valued at 60 cents. Wall's price to tangible book value per share right now is about 0.76 times. The mean is 2.2 times. Looking at the PE ratio, the average PE ratio over the past 5 years is 11.4. Current PE ratio is 3. I personally think that this stock could be trading at least twice where it is right now, if not 3 times where it is right now. There you guys have it. Those are my 5 stocks to buy in April 2023. Right now, I am personally invested in these companies, full disclosure. If you want to follow all of my trades in real time, be sure to check out the Stock Dads Discord. This is where we have all of our trading alerts, education, mentorship, live streams, and so much more value. Go check it out, link in the description. I'll see you guys in next week's video. Good luck investing.